In this video, we're going to first go over what receivables are and how we're going to handle receivables and do a problem related to that. So first of all, let's look at what a receivable is. A receivable is when a customer owes the company money because they've already provided the good or service to the customer, and now the customer needs to pay them. And receivables are typically seen as a good thing because the sale has already been completed, everything's been accomplished. But there is a risk factor associated with receivables. And the risk factor is that the client has not paid for the good or service, and so the company is already out for either the time associated with providing the service or the good itself, and they can't get that back. And so what is it that's really the resource for the company? Is it the fact that a client owes you money, or is it the fact that you're going to collect the money? So it's kind of like if someone owes you money, is that really a resource or benefit to you if you don't think they're going to pay you? Well, probably not. However, if you thought that that person was going to pay you, then you would be able to include that in how you're going to deal with your monthly expenses. So the same thing goes for a company. The management needs to have an idea of what they're going to collect, not what is owed to them. We need to let the public know the true value of the resource, not what's owed, but what is going to be collected. So when analyzing accounts receivable, we need to estimate the bad debt. How are we going to deal with bad debt that we think is going to occur? Well, there's two methods, and the first method completely ignores any of that. The first method is called the direct write-off method. And under the direct write-off method, there's no estimate made. So I put step one, wait, that's not really a step you see in the book, but I wanted to emphasize that nothing is done. The receivable is reported at what the receivable is. No estimate is made of what the amount is going to be that's not going to be collected. And then later on, if the debt is determined that it's not going to be collected, the receivable is going to go bad, then at that point you write it off. So for example, let's say in March we have determined that ABC company is not going to pay us. We write it off and we expense it in March. Now the problem with this is that back when we had the debt, let's say January, February, at that point we really knew that there was going to be a chance that some of our clients weren't going to pay us. This is typical for a big company that has a lot of receivables. And so if that's the case, then the direct write-off method is not really going to work. Instead, what we have to use is a different method. Now the direct write-off method will be fine if you have a small company that doesn't have a lot of receivables, it's not a big part of their business, or a big company that doesn't have a lot of receivables. So if the receivables are just an immaterial amount, just a few things from time to time, then we don't have to worry about it, and it's fine for us to use the direct write-off method. However, if the receivables make up a significant part of our organization as part of the normal operations, take for example Coca-Cola. They bottle the product and they provide it to the grocery store or convenience store or wherever, and then later on the store has to pay them when the invoice becomes due. So that's just the normal way of them doing business, and because they're such a big company, they do business with so many organizations, there's no way they're not going to have some level of bad debt. And so if that's the case, then if Coca-Cola reported all of their receivables and ignored the fact that they knew that some were not going to be collected, that would not be reporting the business in a fair light. And so what we'll do is we'll estimate, so I call this step one, we estimate the bad debt. So we've accrued it on 12/31, an estimate for $1,000. And that's when the expense hits. And so what this does is it matches up the expense with the revenue. So that matching principle is met. So that's why allowance method is considered GAAP, because it does meet the matching principle of GAAP, whereas typically speaking, the direct write-off method does not meet the criteria for GAAP. And because of that, direct write-off method is only allowed under GAAP if the company's receivables are immaterial. So now that we've estimated our expense, later on when we realize a specific item is not going to be collected, so ABC company is not going to pay, then we're going to write it off. Now notice I used an abbreviation for allowance for, or allow for DA. It's allowance for doubtful accounts. So what we've done is we've created an account that's called a contra asset, and it's going to go against accounts receivable and net receivables down. So this original estimate is going to bring down your value of your receivables to a level that you think is going to be rightly collected. And then when you write it off, so when that specific thing comes in, you don't expense it. You write it against that contra asset. You write it against the allowance for doubtful accounts. And then you reduce your accounts receivable because you don't think it's going to occur yet. Now, the question comes up is, how do we estimate this $1,000? So there's two ways. One way is to base it on sales. So if you base it on sales, then what you do is you take a percentage of sales and you put that amount in the journal entry. So bad debt expense, allowance for doubtful accounts, we estimate at 1% credit sales, and so our credit sales are $100,000, so that's where we got $1,000. These numbers are all just given to show you how it works. However, another method is to use accounts receivable as your basis for your estimate. Now, you got to be careful because this is significantly different from the first method. In other words, let's say we estimate 5% of our receivables, and our receivables being $30,000, that would give us $1,500. You don't just jump in and put $1,500 and $1,500. That would be a big no-no. That's not what you do. What the $1,500 represents is the targeted ending balance in your allowance for doubtful accounts. And so you need to know your beginning balance in order for this to work. So if your beginning balance is a $700 credit, so that means to adjust the $700 to get to $1,500, we need to adjust it by $800. And that's the amount that you would use in your debit and credit for your transaction, for your journal entry. So in other words, it's kind of a two-step situation where you first find out what your balance is, what you need your balance to be, and then what the adjustment needs to be. This is different if it's based on sales. You don't care what the balance is, you just put that amount in. Now, what if the balance is not a credit balance but a debit balance? You got to be careful when you do the problems, because if they do that, if you just assume it's a credit balance, you could get it wrong. So let's say it's a $600 debit balance. In order to get this to be $1,500, the adjustment needs to be $2,100, because you need to make up the difference, the credit, to turn it into, you need to make up the debit to turn it into a credit of $1,500. So you're going to have $2,100. Now that we know that, let's go ahead and look at a problem. All right, let's look at this problem, E6.9. So Taylor Swift Incorporated, and these are their balances. So the accounts receivable, the allowance account is a debit and balance, and the sales revenue is $680,000. They want to estimate based off of 4% of receivables. So we're just going to do part A for now. So starting out, let's set up our allowance for doubtful account, T account, and we can see that the beginning balance is $1,750. Let's get the targeted amount. Our target amount is going to be $3,600 because that's going to be 4% of the $90,000. But in order to get from a debit balance to a credit balance, we're going to need to add the $1,750, not subtract it. And so based off of that, we can set up our journal entry. And we see it's $5,350. Let's look at part B. In part B, it says that there's 5%, so it's a little bit different, of the gross accounts receivable, and they changed the allowance for doubtful account to be a $1,700 credit balance. Right? And our adjustment then is going to be 5% of the accounts receivable. So since 5% of the accounts receivable is $4,500, that's what we want our target to be. And so our journal entry then needs to be $2,800 in order to get the debits to equal the credits and to get our allowance account to equal. So that's how we do that problem, and hopefully by now you'll kind of understand how the allowance for doubtful accounts works in conjunction with the receivables account to give us a better overview of the value of what we expect to collect.